All right, guys. I think I am, in fact, live again. We meet again. Let's see. What do we have here? Just getting everything set up here, guys. So bear with me for a second. Should have had this done beforehand, but I'm just getting everything completely set up. All right. So what I did a little bit different today, instead of going over the most common questions as far as life insurance is concerned, I did a search on Google for the top 20 questions that were asked today regarding life insurance, and I thought I would go and answer those. I do this every day, so if you have any questions about life insurance, feel free to hop in and ask your questions. I'm more than happy to help you. Because you ask a question doesn't mean I'm going to try to get you a policy with me, right? So you're more than welcome to ask a question if you're confused about anything, term, whole life. You're confused about which companies to go with. You're confused about which policy is best, or is this policy as good as they say it is? Anything like that. Feel free to ask those questions. But until that point, until I gain traction on YouTube, I'm just going to go through the most common questions. If you have one of these, I will be happy to answer it. So number 20, let me try to pull this into frame a little bit so we can take a look. Number 20, what happens if the insurance company denies a claim? The only time they really deny a claim is if you violate one of the exclusions in the policy. Like maybe in the first 2 years there's a contestability period where they have a chance to deny the claim, just to investigate that everything that was on the application was in fact true. Only time this is really triggered is if there's wild discrepancies between what you put on the application and what's in real life. For example, if you get a life insurance policy today, you say you're 6'1", 160, and next week you die, and it turns out you're 5'7", 295, then they might they might deny the claim. Suicide and criminal activities in the first 2 years, those are definitely going to be denied. After the 2-year period, it really depends on what exclusions they have in the policy. Sometimes the suicide clause is carried over. Sometimes the criminal activity clause is carried over. Oh, sorry about that. But the only thing I can really recommend is don't commit suicide and don't commit crime. So if you have issues with either one of those, please seek help. Okay. Yeah, the policy cancellation due to non-payment, you get 30 days grace period with the insurance company. So if you miss a payment, maybe you switched bank accounts, maybe you were using your credit card and that expired. Usually they'll give you a 30-day grace period. If you have an agent, a good agent, they will get a notification whenever you miss a payment. So in that case, they will reach out to you and say, "Hey, Miss Jones, Mr. Jones, looks like you missed a payment. Was this because you changed banks, you changed credit cards, or is it because you no longer want the policy?" So it's always useful to have a good life insurance agent. Will my beneficiaries have to pay taxes on the payout? No. Usually they're tax free. It's a tax free death benefit. The only time that this might come into play would be if the life insurance was set to go to your estate as opposed to a beneficiary. So, like, let's say you don't have a beneficiary selected, or if you had a beneficiary and they passed away, unfortunately, and you haven't updated that, then it would go to your estate, in which time it is subject to taxes. So always keep your beneficiary up to date. It's always good to have like a secondary beneficiary and possibly a tertiary if you have 3 people that you would like to add to your policy. Can I name my pet as a beneficiary? No, you can't. I wish I could. Well, I wish I could for at least one policy. I love my pets personally, and they are very, very great dogs and cats. But unfortunately, you can't name them as a beneficiary. You can set up a trust in their name and put the money in that, and then leave that to a specific person. or if you have someone you want to take care of your pets, which, I mean, that is an awesome question, by the way. If you have someone you want to take care of your pets in the event of your death, you could always have a secondary policy that would just go to them. Let's say $250,000, $500,000, whatever the case may be. You can set up a life insurance policy and have them as a beneficiary and make sure that they are going to be responsible for your pets, right? I think most pet owners that are going to go to this level of efforts to take care of their pets are probably going to have a good vetting, vetting process to pick someone to care for their animals. So that was a little dad joke I snuck in there, but yeah. Can I name a charity as a beneficiary? Yes, you can. You can name a charity, a church, whatever you choose as your beneficiary. Number 16, who should be my beneficiary? Typically, it's going to be the person that is going to be responsible for your financial obligations when you pass away. So if you're married, it's going to be your spouse. You know, if you're not married and you have kids, and they're going to be responsible for taking care of your estate and all of your finances afterwards, then they would be the ones named. But really, there's no limitations on who you have to choose as a beneficiary. I am a good candidate personally. I will be a good steward of your money, but no, it's gonna be your spouse more than likely, or your kids. Now, one thing about the kids, if they're under 18, it will go to their caretaker, and you want to make also, just like your pets, you want to make sure that it is someone that can be trusted to take care of that money. All right, let's see. What is number 15? What is the free look period? That is a great question. The free look period is the first 30 days that you get a life insurance policy. In the first 30 days of you having a life insurance policy, you can cancel that policy, and you can get every penny back. Now, this is an interesting story on why this thing exists. Back in the day, and you guys might not be old enough to remember this, but there used to be a lot of door-to-door salespeople, and they would go around and they would sell vacuum cleaners, or whatever the case, vacuum cleaners, encyclopedias, whatever. And they would use high pressure tactics. And most of the time it was either stay at home moms, or senior citizens. And they would apply a lot of pressure to these people to buy their products. So all these people bought these vacuum cleaners, encyclopedias, all this other stuff. And eventually there was so much of a ruckus raised that Congress actually did something about it. So Congress passed a rule where, like, if you purchase something like that, within the first 30 days, you get your money back. And they also applied that to life insurance. So in the first 30 days, you want to cancel your policy, absolutely cancel it, get all of your money back, and you'll get all of your money back, and there will be no penalties for that. What is the best way to get the cheapest rate? All right, well, the best way to get the cheapest rate is to find the best company, or the best companies, right? Apply when you're young, when you're healthy. That is the best way to do it. Not be a smoker. That smoking is a massive red flag for life insurance companies. I'm not familiar with any company as of today that actually doesn't treat smoking as a massive red flag. Mutual of Omaha, a few years back, they used to have a policy in place that would let you get non-smoking rates for the first 3 years. Sorry about that, guys. And after the first 2 to 3 years, they would send out a swab. So you did a little swab in your mouth, you sent it back. But Mutual of Omaha, I think it was a lack of compliance on part of the clients, or the people who were smoking 2 years prior didn't stop. So there was a lot of headache involved in that. It wasn't really worth it, so they canceled it. So as of right now, I'm not familiar with any companies that actually give smokers a good rate. As far as how much more it's going to cost if you are a smoker, it's usually between 4 to 5 times more expensive for term policies, and it is significantly more expensive for a whole life policy, depending on which company you go with. All right, but yes, the best thing to do is apply when you're young and healthy. I would say get a 30-year term so it can cover you through to retirement. All right, will my premiums ever go up? Okay, with whole life policies, they are not set to increase, right? With term policies, with a level, right, they are not set to go up until they expire. Now, there is a policy type out there that's called a renewable term, which means you get it at your current age. Let's say you're 50 years old or so. You get that policy, and it will increase when you're 51. They will readdress the amount of the cost when you're 51. So When you got it when you're 50, you were being charged for a 50-year-old, you'll be charged for a 51-year-old, and then every 5 years, it will increase. It will reassess the cost based on your current age. Now, this is a policy that I don't like, right? I don't see the benefit of the renewable terms. So there is a company out there where it looks like it's whole life insurance. Like it looks like it smells like it sounds like it, but it's a renewable term, and a lot of seniors get duped into getting that. So if you see a price that is like way too good to be true, make sure you read the fine print. But whole life policies don't go up. Level term policies don't go up. Let's say you have a 20-year term, level, the price won't go up. Now at the end of the 20-year term or 30-year term, that sometimes life insurance companies will have an automatic renewable. It will automatically renew at the new age. So you're 35, you get a policy. You turn 55, it expires. Then it will automatically renew on an annual basis. Sometimes that happens. That isn't. You have to read the fine print of your contract. Now, if that is the case and it's going to renew every year, let's say you turn 55 and you still need that high level of coverage from a term policy, then the best thing to do is to contact that insurance company and to get another level term with them. But yes, try to avoid the policies that increase in price. You really have to read the fine print, and you really have to work with someone that you can trust. All right. So what medical history do life insurance companies check? Okay. Well, typically they check your height, your weight, your height, your weight, your smoking status. Those are standard. Your BMI is important. Like if it's over 42%, more than likely you're not going to get a term policy. But most of the time they're pretty lenient with the BMI unless it's excessive. Now, whenever you fill out an application for a life insurance policy, life insurance companies will check your MIB report, Medical Information Bureau report. Now, this is just a database of all of the times you've gone to the doctor in the past 7 years. So anytime you've been gotten a checkup, anytime you've been prescribed a medication, whether or not you took it or not, it's going to show up on this report for 7 years. So whenever you fill out an application, they are going to check that to make sure that you are in fact healthy, or whatever conditions you say you have. So just be aware of that does happen. The only time where they don't check your Medical Information Bureau report is if you are applying for a whole life policy with a 2-year wait, right? So it will be like Colonial Penn, where you have the 2-year wait period before they pay out for natural causes. So guaranteed issue policies are the only ones that don't check your medical history. All right, let's see. What is the next question? All right, how much does life insurance cost? This is a great question, and I hate to say that, but it really depends on the type of coverage you get, how much you get, and your health status, your age and your health, right? My primary focus is trying to get as many parents, and it's very hard, to get policies, as many parents with kids under 18 to get policies. I pulled up some just basic prices this morning for a video I did, and this is between the ages of 25 and 50. This is for a $500,000 30-year term and a $500,000 20-year term, depending on the age. And as you can see, when you're 25 years old, $500,000 30-year term, if you're in excellent health condition, is about $27, which I think is phenomenal. This is for a male, non-smoker, excellent health. And this is the worst case scenario at 65. And when I say worst case, you're probably getting close to the morbid obesity level. You're taking medications for several different conditions. So that would be worst case scenario. So between 27 and 65, most people are going to be between 27 and I'd say 35 or 40. But this is just an idea of what it costs. Here's a 35-year-old male, excellent health condition, 30-year term for $34. So, to me, it doesn't make any sense for parents who if they have kids under 18 not to have this. It's absolutely ridiculous to me personally that every parent doesn't have this, especially unless they're multimillionaires or they have medical conditions that would exclude them from a term policy. But yeah, I went all the way up to the age of 50. 50, if you're in excellent health condition, a 20-year term would be $69.23. And if you're borderline getting denied, it would be $170. So you see, the older you get, the more it's going to cost. And that's just a rough estimate. For a whole life policy for senior citizens, I'd say if you're looking for a cremation, I would probably budget maybe $35 to $40 a month, depending on your age. If you were looking for a burial, I would probably budget anywhere from $70 to $80 a month for enough coverage to cover the cost of a burial or cremation. That's a good rule of thumb. Do I need a medical exam? No, not always. I mean, most life insurance companies these days don't require a medical exam, and there are a few exceptions. If you get a large amount of coverage, typically 3 million, 4 million plus, they are going to want you to go into a Quest diagnostic center to get your blood pressure, check your height, your weight. They're going to make sure that you're not dying, right? So medical exam usually for the higher amounts of policies. Sometimes if you're in your 60s and you're looking for a high amount of term coverage, they might want you to go into a Quest diagnostic center or something like that. Most carriers don't require a medical exam for for most people. Like most people getting life insurance will not have to take a medical exam. All right, so does my employer provide does my employer provided life insurance cover enough? No, not really. It depends, right? Uh, Typically, it's $50,000. Sometimes there's 1 to 2 times your base salary. They do have options to add additional coverage on. I think a few carriers, at least the Fortune 100 carriers companies, will let you add like up to 4 times your salary. That's great, but I would never depend on that exclusively. I would always have a policy of my own, and then if something were to happen, the employer provided insurance would be icing on the cake. So, yeah, most companies, well, a lot of companies provide at least 1 time your annual salary. But I mean, if you're making $70,000 a year and your family gets to 70,000, that's better than $0. But how long would that really last? Like if you've got kids, you've got a mortgage, you've got all of these responsibilities. Typically, 1 time your annual income is not going to do very much. Can stay-at-home parents get life insurance? Yes, of course they can. They can get life insurance, and usually I have not pulled up the prices for females, but it's more than likely it's going to be about 10 to 15% less expensive than this. So if you're a 25-year-old female, more than likely it's going to be $22 a month for 500,000, just because women live longer and than men do. How much life insurance do I need? Well, there's a couple different ways to look at this. The most common is 10 to 12 times your annual income, and the idea behind that is you invest the money that you get, and that, remember, it's tax free, so it's going to be tax free. Your salary is not tax free. So if you get 12 times your annual income, then if you invest that, the thought is that you will get back in your investment every year enough money to replace your current income. Now, if you get a price for that, if you do a price check and you do 10 to 12 times your income and it's too expensive, a good way to do it as well is just to wipe out all of the debt. That includes the mortgage, the personal loans, the car loans, credit card, all of those things, and that is a great place to start. That is more than $0. So do I even need life insurance? Well, it depends, right? I think if you have people to depend on your income, you should absolutely have it. I think if you're married and you guys are a partnership, you both contribute to the pool to sustain each other, then yeah, I think you should have a policy in place to help protect your spouse. If you're a senior citizen looking to cover the cost of a burial or cremation, you don't have the money to do it out of pocket, and your kids can't or won't do it, I think you should have a policy. If you get a house, if you have a mortgage, I think you should have a policy in place to protect that mortgage. The crucial time, in my opinion, is whenever you have kids. Like if you make a human being, you should have a policy to protect that human from your loss. So that would be my recommendation. The only time that I absolutely positively stress getting life insurance is if you have kids under 18. But yes, I think in all of those scenarios, you should in fact have life insurance. How does life insurance help me financially? Yeah, I think the summary that they have here is pretty straightforward. It replaces lost income, pays off debt, covers funeral costs, funds education, and protects your estate. Yes, that is a good way to do it. I would add in there that it protects the obligations that you were trying to fulfill with your family, right? So when you started out your family, your goal was to raise your kids, to pay off the mortgage, to build up a retirement account. Those were the things that you were you tried to accomplish. I would say more likely you were obligated to accomplish. And if something happened to you, life insurance comes in and fulfills those obligations on your behalf. What is whole life and what is universal life? Universal life. Oh boy, this one. There are a lot of people out there selling universal IULs. Whole life insurance is a policy. Well, let me go with term first. Term is a large amount of coverage for a very little bit a month. I did the illustrations for some of the ages there. So you get a lot of coverage for a little bit of money. It does last a certain term, a term of your life. Typically with the term policies, you want to get them when you need them. Like if you have a mortgage, if you have kids, and you want to make sure that that policy lasts until you no longer need it, until the kids are out of the house, until the mortgage is paid off. I recommend having a policy in place, a term policy until you retire. So it's a lot of coverage for a little bit of money that lasts a certain term where it's needed the most. Now, a whole life policy is a little bit different. It's a much, much smaller policy, and the cost is significantly more, but not so much where people can't afford it. So, for example, a term policy, you can get 10 times the amount of term for 1/5 of the cost of whole life, if that kind of puts it in perspective for you. Whole life policies, they don't cancel. There's no term expiration. It's going to last you your entire life. Of course, the payments don't go up and the coverage doesn't go down. You've all heard that. One of the selling points is it builds cash value. It does after 2 to 3 years. These policies are best suited for burial or cremation, in my opinion. Like if you're a senior citizen looking for burial or cremation, those are the policies you're going to look for. And I would start with anywhere from 5 to 15,000. I would start at what is needed and then kind of go up from there, just to see how the prices feel first, and then add more. The index universal policies, these are investment accounts with life insurance components. So you would contribute a lot more money to them, like $600, $800, $1,000 per month. And the idea is that once you get this money in your account, it follows the market. So if the market goes up, like 10%, your money will go up by 10%. Usually it is capped. It's capped at like 10 to 12%. So if the market goes up 20%, you only go up 10. And the positive is if the market goes down, your money stays flat. Depending on how it's structured, there's still going to be fees involved, even if it does stay flat. But yeah, these are best suited. These aren't for most people. I don't know if they're really for anyone. The first 3 years is a lot of fees. You can't take your money out for the first 7 years without facing a lot of penalties. I think if they are suited for anyone, it would be people probably making over $250,000 a year that have their Roth funded fully, their 401k funded fully, and probably some secondary investments on the side. But those are the three major types of life insurance. You see a lot of people on TikTok or Instagram talking about the IULs, how you can become your own bank. You're not going to be your own bank for at least the first 7 years. Yeah, I mean after the penalty phase is over, you are going to build money and you can borrow against it. But yeah, most people it's going to be term or whole life. All right, I just covered this. What is the difference between term and permanent insurance? Term and whole life insurance. Term lasts a certain term of your life, much more coverage for a lot less money. And it's for that term of your life where it's needed the absolute most. Now, the permanent life insurance, I think I've covered that too. It's much more expensive. It lasts your whole life and is best suited to cover burial or cremations. Yeah, what is life insurance? I think this is pretty straightforward. It's a federally and state regulated contract between you and a life insurance company. Your end of the contract is to make the monthly payments called the premiums. Their part of the contract is to pay your family, your beneficiary, when you die. That's essentially the essence of the contract. So it's a federally and state regulated contract between you and a life insurance company. All right, so that answers all of the most asked questions on Google today. And wow, I had 23 views here. I am so sorry, guys. All right, so someone said, Jesus loves you. Jesus loves you so much that he died on the cross for your sins, rose 3 days later. Follow Jesus, repent, and be saved and spend eternity with Jesus Christ in heaven. Okay, cool. Yeah, absolutely. Preaching to the choir there, buddy. Okay, and I've got a one viewer online. Not sure who is here, but you're more than welcome to ask any questions that you have. I do this live every day. I go through and I answer all the top 20. Usually, I answer the top 20 questions on Twitter or I'm sorry, X. And today I just went to Google and answered the top 20 questions. But if you have any questions about life insurance, where to get it, what's the best companies, anything like that, feel free to ask those questions. I do have a viewer in there somewhere. Don't be shy. Don't be shy. I'm not going to try to sell you anything. Promise. You are more than welcome to ask any question that you have about life insurance, or I've gone through this already, and I do this every day. So more likely, if you had a question, I've answered it. Oh, you left me. You left me. All right, that's fine. All right, I'm gonna keep doing this until until I actually help someone. Let me see if I have any. Let's see if I have anything in here so far. No, I do not have any other questions other than the Jesus loves me, which I do appreciate that. And currently, I don't have any views. Okay, okay. Apparently, I did have 24 people hop in, and they lasted 42 seconds. So, hey, I had an audience for roughly 18 minutes. Not bad, right? Not for life insurance. I know life insurance is boring, guys, but it is imperative. It is absolutely imperative that if you have kids under 18, that you have something in place. You know, the work policy is not going to be enough. The GoFundMe is not going to be enough. You know, and it's so inexpensive. It really, really is. It's just insane how inexpensive it is. I mean, this is just for the $500,000 worth of coverage. Most people aren't going to be worst case scenario. And my recommendations, if they are worst case scenarios, they probably need it the most, right? Um, they probably need it the most. So the best time to get life insurance is when you need it and whenever you're younger and healthier, right? So like a 30-year-old, 35-year-old, I think that is a fantastic time to get it. In fact, I would say the sweet spots to get life insurance are right here. Like if you don't have life insurance in between the ages of 35 and 45, I think that is a phenomenal time to get life insurance. First of all, like a policy can take you all the way through to retirement. This is probably the last 10 years that most people are completely healthy. And when I say that, like once you're 45 or so, you have to go to the doctor every year, right? You have to go you go into the doctor, they put on the rubber gloves, they break out that pipe with a camera on it, and once they start checking for stuff, typically they find it. Like they'll find the high blood pressure, the high cholesterol, they'll find the early diabetes, they'll find a lot of things that will either increase the cost of your life insurance or they will exclude you completely from some of these term policies. So just be aware of that. If you don't have life insurance, I would highly recommend it. Another thing to kind of be aware of is I believe 18% of people in the United States don't make it to retirement. I think it's like 18.5% of the people don't make it through to retirement, which I think is a tragedy. But yeah, if you're between 35 and 45, you're probably still in relatively good health. I would get a policy that would take me through to retirement, especially if you have kids or if you got a mortgage or if you got anybody who depends on you. That's when you should absolutely get it. And 35 to 45 is a good time to do it, right? Because once they start putting on those rubber gloves, they're going to find stuff. They're going to find, like the high blood pressure, cholesterol, COPD, maybe. But oh, I've got a viewer. Hey, viewer, how are you doing today? I'm talking about the most interesting subject on the planet: life insurance. Go ahead, scroll. Go ahead. I know you want to do it. No, if you have any questions, feel free to ask. I've gone through the top 20 most commonly asked life insurance questions on Google today. But I would be happy to answer any questions that you might have. So, and there is no obligation. I'm not going to try to sell you anything. Oh, you left me. You. No, I don't. I don't blame you. Life insurance is not for everyone. But hey, I did have 25 viewers today, so that's something, right? All right. Well, if there are no questions at all, then let's see. I guess one thing I could do would be I could complete my chart, right? I can complete this chart, go through and get some quotes for females aged 25 to 50 to see what their price would be. That could definitely be something I could do. But if there are any questions, you're more than welcome to ask them. I've covered the top 20. Hey, one viewer. I was talking to myself until you showed up. Hope you're having a great day. If you have any questions about life insurance or anything else, feel free to ask. Mm. Nope. All right. That is fine. So I'm guessing what I'm going to do now is I've gone through the questions. I'm probably going to fill out this chart for women age 25 to 50 for the same amount of coverage. The goal is to show parents how inexpensive this stuff is. So hopefully there won't be any more parents that are lost and the GoFundMe's are set up. That would be ideal. I really hate seeing those, especially if there are kids involved, especially since it's so inexpensive and so easy to get. So, all right. Well, I am thinking about stepping away briefly if there are no questions. On the bright side, I had 23 viewers, 25 viewers. Oh, that's not bad. 25 viewers. All right. Well, if there is no one on here right now, I might take a quick break and come back and hopefully populate this for the females. I'm probably going to go live on Facebook as well. And I'll see if there are any more questions. Usually there's some questions on Facebook. I don't like responding to people who ask questions on Facebook. Not because I don't want to help them with the answer, just because there's going to be like 50 or 60 other people doing the same damn thing. You know, I think we have a reputation for being very pushy, very salesy, all those negative things associated with life insurance. So I don't want to add fuel to the flame because it's already added by other people. If you catch my drift, like if someone posts a question about life insurance on Facebook, they're going to get like 15 to 20 business cards. They're going to get like, call me, call me, call me, which really doesn't do anyone any good, does it? No, not really. All right, ladies and gentlemen, I will return shortly. And let me also put in my link. I'm going to put in the link for my agent link for Banner Term. In my opinion, this is the best term policy in the United States. This is the one that I currently have my policies with. It's the one I write more often than not. So not only am I an agent, I am also a client. So I will put this in there. I will send this out. And that should be valid for all states except for New Hampshire, Maine, Vermont, Connecticut, Rhode Island, just those northeastern, and New York, unfortunately, just because they've got more regulations than other states, and a lot of life insurance companies will not operate out of the state of New York. But New Jersey, down and over, I am fully licensed in. So append this, and I shall return momentarily. All right, I am back. Hopefully everybody is good. We don't have any viewers currently, and there is a little bit of a delay, but I am back. So what I'm going to do here is I am going to fill out my chart real fast. So this is for males. Let me close this. This is my count. It's a slow process. It's a slow process, right? All right, I am going to do the same thing here. And I'm going to get a quote for every female between the ages of 25 and and 50 for a $500,000 policy. So if you're a stay-at-home mom, or if you are working, you can have a basic idea of how much coverage it will cost, right? That is what I'm doing this for. So, because one of the things, like my biggest thing here, my biggest thing is to make sure that every parent has a policy in place. Now, if I could accomplish anything in the life insurance space, it would be to make sure every single parent had a life insurance policy, especially if their kids are under the ages of 18. So this is for a 30-year term for a 25-year-old female, $500,000, and that would be $22.41 a month. That's assuming they're in excellent health condition, and if they are barely able to get qualified, the BMI is going to be really high. They are going to have a few different health issues. It would be $54.79. So that is for a 25-year-old female, as we can see here. Best case is $22.41. Worst case is going to be $54.79. Most people are not going to be worst case, right? Most people age 25, it's going to be probably between $22 to $32 a month, right, for $500,000 worth of coverage. So if you have kids and you're 25, please get life insurance somewhere. You don't have to get it with me, but You need to get it from someplace. All right, so now we're going to go to 26. We're going to go to born in the year 2000. Y2K did not take us out. So worst case at 26 is going to be $55.45. The best case at this age, so they are in really good shape, no health issues. Maybe they've got a couple little love handles or something, which is fine, but that would be $22.53. All right, so that is age 26, female, non-smoker, obviously. If you are a smoker, they consider that a health issue. So let's go for age 27, a female age 27, $23.05. And let's say that they are in not the best of health. They are barely going to get qualified, $56.09. All right, and let's go a little bit older. We're going to do a little bit older. We're going to keep getting older. That's what we do as humans, right? We keep getting older. So it will be $57.37 a month if they are barely able to get qualified. If they are in excellent health at the age of 28, it will be $23.40. And here is an example, right? Here's excellent health. Let me see if I can get this over here for you. So this is excellent health. This is they are in excellent health. They are 28 years old, 28-year-old female in excellent health. $23.40 for a 30-year term at $500,000. That is an insanely good price. Now, if they are in a condition where they are barely going to get qualified, it's going to be more expensive. But most people at this age, between 25 to 35 especially, are going to fall in the first three categories. You know, between 23, 28, or 23 to $40 a month. So that's what most people are going to fall into, which I still think is a phenomenal price to make sure that your family is protected. But I'm just going to give the best case and worst case scenarios. A lot of times whenever you see those ads online, you know, I got $1 million worth of coverage, they have these ridiculously low prices. That's because they're doing a 10-year term. Like, they're always going to show you the best possible rates. They're not going to show you the actual thing, and that's what I'm trying to do here, is kind of go through and show you a more realistic price as far as like how much coverage you can get. Most people aren't going to get a 10-year term policy unless they're at the tail end of getting the kids out of the house and having the mortgage paid off. Most people, it's going to be a 20 to 30-year term. I did the 30-year term for the younger people, but a 20-year term can be just as good. You can always get more coverage later as long as your health doesn't change, and the price won't be significantly more expensive. One good thing about Banner Term, the company that I represent mostly for term, is that in the first couple years you can add more coverage to it, and you will be at the same health condition that you originally applied to. All right, so we're going to go. We're going to get the 29-year-old female. See how much it's going to cost for her, and this is going to be below average health, and that is going to be $58. So remember, she's barely going to be able to get qualified. She's BMI is probably high, a few health issues, but for a 29-year-old female in excellent health, it's $23.75, right? And I'd still say for most people this age, most females this age, it's going to be between 23 to 35 or so for the coverage. All right, so let's get a little older again. We're going to go for the big 3-0. I know a lot of men and women have issues with turning 30. Looking back on it, I wish I was 30 now. That would be a nice thing. I think no matter what age you turn, you always kind of look back and you're like, I mean, I wish I was that age again. So that just shows you really need to appreciate your age no matter what it is. All right, so we're doing age 30, and this is age 30 in the worst possible condition for a female. The worst possible condition to get approved, and that would be $59.27. All right, let's get a little bit older. We're going to go all the way to 50 here. And I might do a video on this, really to show parents how inexpensive this stuff is. Every parent that has a kid under the age of 18 should have a policy. All right, so this is 31 years old, below average health, and that would be around $60 a month, $60.55 a month. If they are in excellent health, it's going to take a few seconds here to pull it up, and I'll pull this up here. Let's see if there's a way I can zoom out on this to make it more visible for everybody. There we go. Maybe one more. There we go. Oh, one more. There we go. All right, so these are the prices for 30 years. Right now I'm on age 31. And I will make these a different color so as to indicate that they are not yet complete. So, all right, so this is a 31-year-old female in excellent health, $24.83 for $500,000 worth of coverage for 30 years. So let's go down to age 32. I don't remember being 32. I remember being 30, 35, 40, and 45. But age 32 in excellent health, you're looking at $25.67 a month for a 30-year term at $500,000. In subpar health, barely going to get qualified, you are looking at $61.82 for a female. Still a pretty good price, and if you are below average health, that would be a good time to get it as well. Hopefully you get it when you're healthy, where it's going to be less expensive. But if you do have subpar health, it might be a good time to at least consider getting it. All right. But the absolute best time to do it is whenever you need it and whenever you're young and healthy. So for a 33-year-old female in suboptimal health, like in barely going to get qualified, $63 a month. If they are in excellent health, $26.52. And most people are going to fall. They're not going to be on the extreme for the bad health. You know, it might be between $26 to $35 for most females age 33. All right, so we're going to go to age 34. I'm going to kind of see what that's going to be. 34-year-old female, $500,000 worth of coverage in excellent health, $27.37. And yet again, I'm doing the best case and worst case scenarios, right? Don't think it's going to be one or the other. It could be in between, but that's just to give you an idea. Most people are going to be at this age are going to be close to preferred level, close to that best price. And if you got health issues, you should be aware of them, and you'll know what it's like to go towards the other end. All right, so that is 34-year-old female. Let's go for 35, the big 3-5. So a 35-year-old female for $500,000 worth of coverage, who is not in the best of health, 66.28 for $500,000 worth of coverage for 30 years. And if she is in excellent health, it will be $28.42. And most people are going to fall are going to be closer to the $28 than the $66. All right, so we're going to get a little bit older. We're going to go for 36 in excellent health. And that is going to be $29.97. And you see there are several different rankings between the two. So there's excellent, there's preferred, which is very good. So very good can mean like you're a little bit overweight, you might be taking a medication or two, nothing major. And the cool thing with Banner Term is if you are overweight and you're not really taking any medication for anything, you're pretty healthy, they will add an inch to your height to adjust the BMI. so to move you to a higher class. So just that is a great feature of Banner Term. But I'm doing the extremes. I'm doing the super healthy, which most people this age are going to be, and I'm doing like the really kind of unhealthy, right? This is barely getting qualified. So just remember, it's not going to be one or the other. It's going to be it's either going to be like the extremely healthy or someone somewhere close to that for most people, right? But like I said, I do want to give you the full range so you can make an informed decision. And if you do apply and you apply as you think you're subpar as far as the health, if you apply, they might bump you up a level or two. You could always work with me or another agent. They can use the underwriting guidelines to see where you kind of fall as far as the health requirements. All right, so 36-year-old female in excellent health is $29.97 a month. I've covered that one. And the older I get, the less I'm lowering the years to 20. Now, I could have started with 20 for each one of them. That's more than acceptable. You know, that will save you money. Like the 20 years can be less expensive than 30 year, but the idea is to keep it as long as possible, right? To keep this policy in place as long as possible to retirement, you know, if you can. But I mean, if you have a mortgage, it's a 15-year mortgage, 20-year policy is more than acceptable. If you got young kids, 20-year policy will make sure that, you know, you're covered until they get out of the house. So 20 years or 30 years is more than acceptable for coverage. I'm just more inclined to have the coverage last as long as possible. All right, so we're going to go to 1989, which was a good year. 1989 was a good year, in fact. If I'm not mistaken, that was when the Soviet Union fell, right? Was that not 89 or 91? No, something happened in 89. All right, so 37-year-old in excellent health, female, will pay exactly $31.90 or 89 cents for a $500,000 30-year term. And if she were in subpar health, barely able to get qualified, the other extreme, $76.72 per month. And if you notice, like the female prices are lower than the male because they have a tendency to live longer. All right, so now we're going to go to 1988. The year of the really big hair. All right. So a worst case scenario for a 38-year-old female barely getting qualified for a term policy would be $82.64. If she were in excellent health, the other extreme, $34.05, right? And I just don't want to give you the best case scenario. I also want to give you the worst case scenario. So just so you have all the information you need to make a decision. Most people between these ages are going to be healthy, so. And another thing, I just want to show you how inexpensive this stuff is, especially for what it does for your family. So a 39-year-old female in excellent health for $500,000 worth of coverage for 30 years will be $36.09. And if you're a 39-year-old female, if you got kids that depend on you, they've got to be worth $36 a month, guys. I mean, got to be. All right, so subpar condition would be, see, it's getting a little pricier the older you get and the worse your health is. $88.60. So the other extreme would be $88.60. Let's see. Remember, it's not an either or. These are the two extremes, best case and worst case. So we're going to get a little bit older here. We're going to go for a 40-year-old female, 30 years of coverage, and below average health, $93.70. Okay. And if she is in excellent health, it is $38.63. Still a good price, still a really good price. Well worth it to protect your family. I'm going to get a little bit older. I'm going to go to the next age group here. 41-year-old female, $500,000 worth of coverage, in excellent health, $41.63. And you can't beat these prices. I mean, there's a couple companies that kind of come close to it, like Pacific, Prudential. They come close to the price, but as far as I've seen, they're there are not many companies that give you this level of coverage for this price, even if you are in below average health, right? So below average health for the age of 41 for a female, 102.68 for $500,000 worth of coverage for 30 years. And I would really, like, if you are below average health at ages 40 or so, that would be a good time to get it, because more than likely you're going to get to the doctor more often after the age of 40. And doctors, their job is to find stuff, and typically they are good at their jobs. So, all right, so we're going to go up a little bit more. We're going to go to age 42. So that would be born in 1984. 1984. I don't remember much about 1984. I was too young, but I'm assuming that it was a good year. All right, so 42-year-old female and below average health. The extreme case would be 110.56 for $500,000 worth of coverage for 30 years. So that would take her all the way to 72. And in the best case scenario, like she's in excellent health, $45.29 for $500,000 worth of coverage for 30 years. All right, so I'm going to go to age 43. 43 in excellent health, $500,000 worth of coverage for 30 years. For a female, non-smoker, obviously, 49.54. Worst case scenario, subpar health, below average health, it's going to be $120.28. Yeah, at this point, you might be consider a 20-year term instead of the 30-year term after 40. I just like to have it cover. I like to have the coverage go all the way to retirement at least. So that's why I'm choosing the 30-year term, but you're more than 20-year term at this age is more than acceptable. You know, as long as the mortgage is paid off, your retirement accounts are good, the kids are out of the house, you know, a 20-year term would be more, would just be as acceptable. Let's see, let's go to the next age, which would be a 44-year-old female, $500,000 worth of coverage for 30 years. And we are going to do, let's see, 1982. All right, so this is going to be subpar health, below average health. Barely going to get qualified at the age of 44. And this might be a time to get a 20-year term. But let's see, that would be 130.03 for $500,000 worth of coverage. 44-year-old female, below average health. That is the extreme case, barely going to get qualified. And if they are in excellent health, $53.61. All right, so this is going to be the end of the 30-year term, because I'm coming up on the 45-year-old age range. And at this point, you know, you're 20 years away from retirement, so a 20-year term should cover you while you know, if there are still kids in the house, get them out of the house, while you're finished paying off the mortgage that should be paid off. So I'm going to switch from the 30-year term to the 20-year term, so the prices are going to start going down a little bit. All right, so we're going to go with the 45-year-old female in excellent health for a 20-year term. This is going to be different. It's going to be, let me pull this up. So 45-year-old female, $500,000 worth of coverage for 20 years is $35.65. So inexpensive, guys. If you got kids, you've got to get a policy somewhere, right? All right, so we're going to go with below average health for a 45-year-old female. And that's a little more affordable. That is $82.22 below average health. Nothing. One of the things that's really depressing is if you do come across a 45-year-old that's been diagnosed with something serious and they are just excluded from the term policy and they still have little kids. I've encountered that a couple of times. It's really, it's rough. All right, so this is a 46-year-old female looking for 20 years of coverage. Her health is below average, right? Below average health. This is worst case scenario, barely going to get approved. It's going to be $89.32. All right, and this is going to be, the next one is going to be the best case scenario, excellent health. $38.47. And remember, these aren't either or. These, it's not going to be like one or the other. It could be in between. It could be like 45 or 50, but I'm just giving you a price range. You know, there's multiple categories between best and worst, so don't assume just because you don't get a 38.47 you're going to get the 117. All right, so we're going to go to another age group here. We're going to go to 1979. Disco is still alive and well. So 1979, and we're going to go for a 20-year term for a 47-year-old female in excellent health. And I want you to take a look at this price, $41.62. Insanely inexpensive. If you still have kids in the house, you're still paying off a mortgage, that would be a good time to get it. All right, so we're going to go for the worst case scenario. Barely going to get qualified. You know, maybe she's gone into the doctor, they found a few things, and she's barely going to get qualified, $95.92. All right, we're rounding up the round. I'm getting close to the end here. 1978. Below average health. Remember, she's barely going to be able to get qualified. 104.08. And the best case scenario would be 45.78. Insanely inexpensive for what it does for your family as far as protection, in my opinion. All right, so we got two more to do. 40, 49, and 50. So a 49-year-old female in excellent health condition, $500,000 worth of coverage for 20 years, $49.69. On the other extreme, completely unhealthy, barely going to get qualified, would be $112.63. All right, and the final, the big 5-0. The big 5-0. Let's see, what is it going to cost for someone that, for a female that is 50 years old for $500,000 worth of coverage for 20 years if her health is below average? That will be $120.47 per month. And I would highly recommend, if your health is below average, to get a policy. If your health improves, you can always get a new one. All right, now the other extreme, $54.35 for a healthy female age 50 for 20 years of coverage at $500,000. So that is both of these charts have been populated, both male and female, from ages 25 to 35, or I'm sorry, 25 to 50 for best case and worst case scenarios. So as you can see, most of the people are going to be somewhere towards the excellent health and not in the extreme, right? You know, not many people are going to be excluded at these ages from a term policy. Typically, it happens after 45. Between 45 and 50, that's when more people start developing issues that exclude them from larger amounts of coverage. So, all right, let me check the chat here. I can't imagine many people sticking around. Oh. No, and I have no one. Okay. Nobody is here. I did get 28 views. All right, that's good, I guess. All right. Let me take a look at something here. Looks like I missed a call from an Animal House grooming salon, guys. I don't know what that is in reference to. Doggy spa and daycare. Okay. Okay. Let me see, recent. Okay. All right. So I don't have any viewers here. I think that covers most everything. I'm gonna go ahead and end the stream.